Um, Hello, welcome back to the continuing lecture series in investments. Now, um, so we need to talk about, in today's lecture, we need to talk about the free cash flow model. So this is the fourth model in stock valuation model. And as the name goes, right, um, this isn't this isn't dividend discount model because it's not the dividend that we are discounting, but it's the free cash flow we're discounting. Okay, um, but in fact, in terms of its methodology, it's still the same thing as it's still like dividend discount model. It's just instead of dividend, we are using free cash flow. But why do we use free cash flow model? Well, you all know very well that dividend discount model um, has a limitation. What kind of limitation? Um, well, if the company doesn't pay any dividend, right? How do you value such a company if they don't pay any dividend, right? And then so the model breaks down, right? The model breaks down if you're dealing with a company that doesn't pay any dividend. Now, so then how do you uh, get around that kind of problem? Well, of course, that's why we use free cash flow model instead of dividend. We use free cash flow. Now, first of all, to define free cash flow, right? Free cash flow is very strictly defined. Just because the name is free cash flow, it doesn't mean it is really, it's liberally defined. Um, it's very strictly defined. It's very rigorous. So let's take a look. The free cash flow is defined as operating cash flow minus investment in operating capital. Okay, so what is operating cash flow? Um, Operating cash flow is actually Ebit minus taxes plus depreciation. Uh, but then, let's think about it. Instead of, you know, um, this is the analytical reasoning, right? What I'm going to do is the analytical reasoning part. Why? Um, uh, these days, we have, um, read out or read aloud feature on most, web pages or even, PDF files. I don't know if Microsoft has. If I try, let's see, does it allow read aloud? Read out. No. Microsoft doesn't have, Office products doesn't have. Maybe Word has read aloud. But when you have, and this also happens with a lot of students, they think reading is studying. If they can read, they think they can understand that. But it's just like running the mouth. It's just mechanically running the mouth. If you just read, this is mechanically running the mouth. So, for example, I mean, if I turn on the read out or read aloud feature um, on the computer or on the web page, it will just say FCF equals OCF minus IOK equals EBIT minus taxes plus depreciation. That is, but or even if that read aloud feature can expand the acronyms, then it will read free cash flow equals operating cash flow minus investment in operating capital. And even the speed is always, you need to slow down and think about it. But the read aloud is just, mechanical. It just reads. It just keeps on reading at a constant rate, or even at a fast. I mean, when people speak, and when they don't think but just run the mouth, they speak very fast. But actually, if you're really thinking, you cannot just run the mouth like that, right? First of all, does it carry? Does it? If I just say free cash flow equals operating cash flow minus investing in operating capital, does it enter your mind? Does it enter your mind? Does it enter your brain in the first place? No, it doesn't. Even if I say, which is equal to earnings before interest and taxes minus taxes plus depreciation minus change in gross fixed asset plus change in net working capital. I mean, even if so reading fast is not studying. Reading fast is not understanding, because reading fast isn't studying. You don't understand by reading fast. You have to, you have to regurgitate. You have to reflect and regurgitate, right? Now, what is operating cash flow then? We know operating cash flow is defined as EBIT minus taxes plus depreciation. First question that might come up to your mind is subtracting taxes from EBIT. That makes sense, because EBIT is what? Earnings before interest and taxes, right? And taxes are not the cash flow that is available to the firm, right? Taxes are not the cash flow available to the firm, so you have to subtract it. Make sense? But then why do you add back depreciation? Why do you add it back in there? So this requires, some thinking. And again, what is another name for Ebit? Anybody? What is another name? Ebit, another name for Ebit is operating income. Isn't that right? Remember this from Finance 230, or if you took, Business 210, right? Operating income. Now, we might wonder, don't they sound familiar, operating income and operating cash flow? But now it is obvious they cannot be the same thing, because operating cash flow is the result of subtracting taxes from operating income and adding back in depreciation. Now, why do we add back in depreciation? Now, if you remember from Finance 230 or Business 210, business math, depreciation is, although it is part of the operating expenses, it's part of operating expense, right? I'm not saying this is equal to operating expense, but it is subset, right? It's part of operating expenses, right? Okay. Or maybe the arrow should be pointing the other way, I guess. Now then, so it's an expense. Expense sounds like, cash outflow, right? But depreciation is not cash outflow. It's actually cash inflow. Okay. Or actually, it's not really inflow, but it's more like preserved. The cash flow that was supposed to have gone out, but actually it didn't really go out, but it was preserved. It is preserved in the company, within the company. So it is not cash outflows, it's preserved cash. So it is cash available to the company. Hence, you put it back there. Okay? Now, what does this mean? Investing in operating capital. Operating capital means what? There are two elements to this. One is, fixed assets, and the other one is liquid assets. Now, changing gross fixed assets. That's clear. What is gross fixed asset? Think about it. What is changing gross fixed assets? It's like you have plant and equipment, right? And the plant and equipment will depreciate over time. Well, depreciation means not only simply in terms of value, right? And that depreciation is this same depreciation as this, but when we say plant and equipment is depreciating, plant and equipment, that means what? Its production capacity is going down due to wear and tear, right? With age and usage, right? With age and usage, all plant and equipment dilapidate, right? All plant and equipment dilapidate, and when they dilapidate, right, it goes down in capacity, output production capacity, right? So then, gross fixed asset, right? The value of the fixed asset goes down, right? That's the negative change, right? Also, the company won't be simply watching their production capacity go down, hands down, with their doing nothing, right? The company won't, because depreciation means asset value going down due to aging, right? Wear and tear and aging, right? And accordingly, depreciation would reflect also decreasing production output capacity, production capacity, right? So no manager will just, no management will just, watch it go down. So what do? They will constantly replace, right? At least constantly replace the worn out portion, the dilapidating portion of their assets, right? And this, physical assets, right? Like plant and equipment, fixed assets, right? They at least replace, right? So the production capacity will be maintained at the current level, or at certain level, or they even if they see an opportunity for profit. I mean, if they see, for example, something like uh, they forecast demand will increase by 10%, right, in the coming year. And over the next 5 years, demand will increase by 10% a year. So over the next 5 years, it will be like at least 50% increase in a demand for their product. Then what are they going to do? They will have to expand their production capacity, right? So replacement, simply replacing the dilapidated portion of their assets, their plant and equipment, or expansion. They need to expand. And then if they expand, then that will be a positive change in their gross fixed assets, right? Or they can acquire they can launch a new product, and new product or completely new product from a completely different line, different production line. And then that will be a new investment in a new venture, right? For for example, for an automobile company, right? For an automobile company, let's say, like Ford and General Motors or Chrysler, the existing automobile company that is built on internal combustion engine, right? In other words, gasoline or petroleum engine, right? Gasoline or diesel engine. That's internal combustion manifold. That's what. Now, if they want to make also electric vehicles, then that's a completely new venture, right? So there are three types of there are three types of projects that a company can engage in, and first one is simply replacement, second one is expansion, third one is venture. But in all of these three instances, then there will be change in fixed assets. Make sense? And then if there is fixed assets, then there is what? Fixed assets are non-current assets or physical assets or real assets. The other part is current assets or liquid assets or financial assets. Okay, current assets. Now, current assets is also called working capital. Current assets. Okay, current asset also called working capital, right? Net working capital is then what? Current assets minus current liabilities. Okay, that's net working capital. Okay, current assets minus current liabilities. So of course, there are current assets. Net working capital will change over time as well, right? So then think about it. Where's the capital? Where's the money? Where does the money come from to support the change in gross fixed assets? In other words, if you're expanding the plant size, if the plant size increases, also so will the production capacity, right? So where does the money come from? It has to come from operating cash flow. Makes sense? It has to come from this. And if there's a change in net working capital, and if it is a positive change, that means net working capital uh, has increased. Okay. So that kind of, change, where does that, additional current assets come from? If this goes up, right? Where does that come from? If the net working capital goes up, where does that come from? It has to come from operating cash flow, right? So that's basically the definition of free cash flow. But this is actually free cash flow to firm. There are two types of free cash flows: free cash flow to firm, and then free cash flow to equity holders. We'll get to this later, right? But for now, see, changing gross fixed assets. That's capital expenditure, right? It's also called capital expenditure. Or CAPEX, right? Capital expenditure or CAPEX. Now, so moving on to the free cash flow to the firm. Okay. Now, this is something we already did in Finance 100. So I'm not going to go over this again. But one thing we have to remember is weighted average cost of capital. Again, it takes time to explain this. So please, if you want to refresh on this, you can look up my Finance 100 videos on YouTube. Let me just show you. But let me explain. First, let me explain. Weighted average cost of capital. Weighted average cost of capital is literally it means cost of capitals are averaged by their weight. And then what does we know cost of capital is basically what? Cost of equity and cost of debt, right? Because there are two capital components, equity and debt. Well, sometimes, we include, preferred stocks, but preferred stock is also basically equity. But, generally we, in Finance 230, in cost of capital topic, right? In cost of capital, topic of cost of capital, right? In that we discussed how to calculate basically, how to separate cost of equity, cost of preferred stock, and cost of debt, and how to evaluate each capital component. But this is basically that idea. But if you think about it, right? Free cash flow is the result of the workings of both equity and debt, right? In other words, free cash flow is like the fruit on a tree, and the tree uh, to grow and care for this tree and to harvest fruit from this tree in the fall, then you will have to fertilize it and take care of it. I want to say cultivate it because tree is already planted, firmly rooted in the ground. But the idea is tree is the like the plant and equipment, right? Tree is like the machine. Fruit is the product that comes out of the machine. And the machine consists of, machine was purchased with capital raised from equity and debt. Make sense? So it's the question of capital structure. Now the fruit is the result of the workings of the combination of equity and debt. So you can say that the contribution of equity is 60%. Contribution of debt is 40%, right, into this fruit. But then where did that 60% and 40% come from? Well, it's exactly the capital structure of the company. It's the proportion of equity in the total capital, proportion of debt in the total capital, right? So that proportion is the weight. So that's weight of equity. So how do you find the weighted average? Weight of equity times cost of equity plus weight of debt times cost of debt. So this is weighted average cost of capital, and weighted average is also called weighted sum because this is summing up two weighted variables, right? And we have to discount the free cash flow by the weighted average cost of capital because weighted average cost of capital is the only appropriate discount rate in this case because, as I said, free cash flow is like the fruit, okay? And then the contribution, and this fruit is the result of the from product of the tree, which is the result of contribution from equity and contribution from debt. Okay, so I'm not. So the idea is that you want to discount all these free cash flows in the future, right? And then it is the current value of the company, right? That's what it means. Then price, and then that formula would involve, right? Discounted free cash flows and terminal value of the terminal value of the terminal value of the free cash flow. And then how do you find the terminal value of the free cash flow? Well, now we use the Gordon growth model because when it goes into a constant growth range, right? Free cash flow is, basically forecasted, and we assume the free cash flow is growing at a fast, uneven, fast rate, up to a certain point, and then goes into steady state, right? So if it goes into the steady state, steady growth phase, then uh, what else can there be? Golden growth model. But in golden growth, so it's exactly golden growth model, right? But instead of dividend, you find, free cash flow at time t plus one, and then you subtract it by k minus g. It's the same thing. But again, I'm not going to go over. This is an example of free cash flow to the firm. Okay, and I want to go straight to the free cash flow to equity holders approach, right? Um, so free cash flow to the firm approach, right? That one needs to be uh, if you are not clear about that, if if you're rusty on that, I suggest looking up the YouTube. So uh, let me show you. And I'll have to stop sharing, and I'll share my entire screen. Okay. So by now you should be seeing my entire screen. Yeah, there you go. Now I have my YouTube channel, okay, whatever you call it, but it's not. It's for all my lecture videos.